Phil Flynn from PFG Best in Chicago, Jonathan Barrett from Commodity Broking Services in Sydney. Warm welcome, gentlemen, to you both. I guess underscoring that call is the fact that corn and wheat and soybean prices all jumping in tandem to levels we haven't really seen since 2008. Phil Flynn, is it the US dollar weakness? What is it? What's really powering this?
You know, that is the underlying cause. But come on, we all know when we look at the corn crop that there has been weather issues all over the globe. I mean, you know, we had problems with wheat in Russia. I think even today in that UN report, they cited the possible frost in China with the winter wheat crop that basically is putting that crop in danger. We have some real supply problems. But let's take it a step further. Would demand be as strong if we didn't have a weak dollar? If we didn't have this burgeoning emerging market? Probably not. You know, demand would be a little bit slower. There's obviously a balance going on here. I think the combination of Fed policy along with you know, some weather issues have really exacerbated what we could see in other markets in the future, you know, unless we get the world back in balance, so to speak.
Well, Jonathan Barrett, speaking of getting the world back in balance, there's lots of geopolitical unrest to key off at the moment. Look at that crude price, how Brent has really been responding to what's going on in Egypt. But in the US, it's all been about supply or oversupply that's governed a decline. So going separate ways, those two crude markets. What do you make of that?
Yeah, Carson, I think that's the mix we've been witnessing over the last 2 to 3 months, where concerns in Egypt are forcing the Brent price up, which is a much heavier crude and not as well sought after as the West Texas. And the West Texas price is obviously coming down because we've got concerns on economic recovery and we've got enough oil out there. So that spread, I think, will remain relatively wide whilst we have concerns in the Middle East. I expect it to come in, but at the moment when we've seen inventories where there are, oil just remains in a range, and I'm really happy that it is in a range, because if it does start to break through that 92.50, then we're going to have more concerns on those inflationary primary imports, grains, metals, all these things. So it's one commodity which I think is well contained.
Jonathan, I was just speaking with a guy out of Chicago, Lincoln Ellis, and he's saying he's looking for things like everyone is that might put an end to the whole liquidity driven party that's going on. Maybe we're comfortable with China and the way it's raising rates. Maybe we're even comfortable with unrest in Egypt at the moment. What about a Bank of England rate hike today? Do you think that would scare the markets, just as it might point to the beginning of the end, if you like, to the liquidity boom?
Oh, look, I think it's something that will eventually have to happen. But Brooke, what we're seeing is quite an interesting phenomenon. We're seeing two types of inflation in the world at the moment. And the Bank of England, I don't think, will put rates up. But I'm happy for the emerging markets too, because the emerging markets are seeing a demand pull inflationary environment. The West is seeing a cost-push inflationary environment. And it'll be the convergence of the two ideas on how we contain these inflations, which will result in how global growth will occur. So in answering your question, I don't think the Bank of England, although they're announcing or they're meeting tonight, will actually push rates up, because we still need that underlying strength in the Western economies to really kick on. And that's what we're not seeing at the moment. Yet, of course, we're seeing it in the emerging economies.
Phil Flynn, if indeed Jonathan's right and it is emerging markets that go ahead of the curve and raise their rates, isn't that going to do exactly what Ben Bernanke didn't want to happen? And that's more hot money exit the United States, searching for yield, more of it getting into emerging markets, less domestically on jobs for you.
I would agree with you, and I think that would be a real issue. And listen, I think Ben Bernanke is happy with the inflation problems that China's having in the emerging markets, mainly because he wanted to give them the problem. I still think it goes back to the Chinese controlling their currency. Ben Bernanke would have never done QE2 if the Chinese didn't control their currency, and I think that's the key here when we get here. Now, if Lincoln, I respect Lincoln, I know Lincoln, and Lincoln has made some pretty incredible calls, and when he told me that, I was like, are you kidding me? And he said, no, I think it could happen. And I wouldn't put it past it. I'll tell you, if it does happen, that does change the rules of the ballgame. You will see the markets react. Even the grain markets will cool off on that. You'll see gold prices come back down, because that does change the lay of the landscape, definitely.
Give us some more details on that. Why that becomes almost... He was suggesting it's like a turning point at that if we actually saw the Bank of England come out and surprise with a rate hike.
It definitely would be. I think it would be, you know, because right now we have this perception here right now that Europe, the Bank of England, you know, that they are on board, you know, with the Fed, that they're happy with the way things are going, that even though they're worried about inflation, they're more worried about growth. I mean, let's face it, the UK's last quarter wasn't that explosive on the growth side. So I think it would be kind of a big leap. But there are real inflation problems. A lot of these economies are starting to worry about them. And I think some of them aren't worried enough, you know, and I really think the Chinese really, you know, missed the boat here, you know, with that interest rate increase. The market laughed in their face. Look at what happened to the price of gold. Look what happened to the price of silver, copper, you name it. That's not going to do it. And listen, Britain is not the driver of inflation. If they raise rates, it'll shock everybody. It can be the beginning of the end, but we're going to have to see more dramatic acts in the emerging markets.
All right, brief final thought as well. We've got some jobless claims out in the United States tonight. Jonathan Barrett, is that number going to kind of move the dollar significantly enough to, you know, fashion the next course on perhaps a bit of another bounce for copper even, which has pulled back?
Look, I think, Carson, at the moment that number is something that the market is certainly focused on. And I think the market really wants to concede this improvement. The last week's number was a number where we expected a lot more out of it. It just didn't get to where we wanted it to be. So I think this report tonight will help to be a catalyst on where we see employment actually moving in the States. It's still a very high number. Bernanke and Obama have all expressed the concerns that it's really got to move. Remember, is the economy moving on the back of the stimulus packages, or is the economy moving on the back of itself? And the jobs data, I think, is one of the key elements to help us determine that. And as a result of that, what we'll see with copper. Remember, copper has had a correction, and in copper, I feel it's just profit-taking at the moment.
Yep. I think that smart money's on you calling that correctly. Jonathan Barrett, Commodity Broking Services. Phil Flynn, strapping tight for the jobs numbers tonight. Have a good one.